The focus of my discussion will be on the Bush-era tax cuts, and in some cases we did go over the cliff, and in other cases we did not, depending on your tax bracket. On January 1st, as I mentioned, Congress passed major federal legislation. The bad news with regards to these tax law changes is that we now have a new tax bracket. We have a top tax bracket of 39.6%, which impacts taxpayers and married filing joint taxpayers with income in excess of $450,000 and single taxpayers with income in excess of $400,000. In addition to this, we have the return of the personal exemption phase-outs as well as the itemized deduction phase-outs. This impacts married filing joint taxpayers with income in excess of $300,000 and single taxpayers with income in excess of $250,000. So although these individuals are not impacted by the higher tax rate, they will likely be paying additional income taxes because they're losing benefit of some of their deductions. In addition, we now have a higher top capital gain dividend tax rate, which is 20%. The top rate prior to 2013 was 15%. And again, this kicks in at incomes of $450,000 for a married filing joint taxpayer and $400,000 for a single taxpayer. The good news is that we finally have permanent AMT relief. AMT is known as, or also called the alternative minimum tax. It's something when it was originally enacted in the 70s, had an exemption amount that was not adjusted annually for inflation. So as the years went by, more and more taxpayers were impacted and affected by alternative minimum tax, and it was creeping more and more into the middle class. So what we did get starting in 2013 is permanent AMT relief, where the exemption amount is now indexed permanently for inflation. In addition, we saw the annual extender bills. The extenders are tax benefits, in a lot of cases, that are put into the law generally for 1 or 2 years at a time due to budgetary restraints. Some of the individual extenders that are most common, there are over 50 of these, but these are the highlighted ones, are the education tax credits, the refundable child tax credit, the deduction for teachers, sales tax deduction. This is one that a lot of our clients benefit from, especially if they're a resident of a state that does not have an income tax, like Florida. Those individuals are able to deduct their sales tax paid on their general purchases or a vehicle or a boat. In addition to that, another one that's very common of the extenders is the tax-free charitable IRA distribution. This allows individuals to directly contribute up to $100,000 from their IRA directly to a charity, not having to bring the $100,000 into their taxable income and then take a subsequent deduction for it, which if you are over the thresholds that I talked about earlier, you could lose some of the itemized deduction benefit. So this allows a direct contribution to an IRA or to a charity from your IRA. But keep in mind, these have only been passed for 2013. We are not sure yet what will happen for 2014 and beyond. In addition, we had business tax extenders, which included the 50% bonus depreciation provision. Bonus depreciation has been in the code for about 10 years now in various forms. This allows businesses, any size business, to deduct immediately up to, or 50% of the cost of new equipment or fixed assets placed in service. The assets do need to be placed in service by December 31st of this year to qualify. We currently do not know, and we're suspecting that they will not have bonus depreciation available in 2014, although that could change. In addition, the equipment expensing Section 179 amount is an amount where smaller businesses can deduct up to $500,000 of qualifying equipment for their business as well. Another item that was part of the business extenders is the R&D credit. The R&D credit was originally enacted in the 1970s and was not part, or is not a permanent part of the tax law, but it is something that has been extended almost every year since originally enacted. And we do expect that this one will be extended. In In addition to the income tax provisions, we did see permanent rules with regards to the gift and estate area. One area that we did see that they made permanent is the idea of portability. Currently, there is a $5 million federal estate exemption amount per individual. A married couple is able to combine this, so it's $10 million, and in fact, it's indexed for inflation as well. The portability is a federal-only provision that allows a married couple to use their spouse's unused portion of their $5 million exemption. So if you have assets where one of the spouse passes away and they had only $3 million worth of assets, they would still have $2 million of their exemption remaining, and that could be used by the surviving spouse. The indexed amounts for 2013 for a married couple is $10,500,000, and for a single taxpayer is $5,250,000, and they did go up for 2014 as well. In addition, they did make permanent and they did change the estate and gift tax rate. It went from 35% to 40%. In the spring, we also did see tax law changes from the state of Minnesota. We saw changes to the individual tax rate, gift and estate taxes, as well as sales tax. With regards to income tax, the top individual tax rate went up 2%. The top rate previously was 7.85%. It is now 9.85%. This impacts taxpayers, a single taxpayer with income in excess of $150,000 and married filing joint $250,000 of income. We also saw a near doubling of the corporate franchise fees. C corporations, S corporations, partnerships pay a minimum franchise fee tax in the state of Minnesota, and like I said, that has nearly doubled. In addition, we saw changes with regards to gift and estate tax. I previously discussed the federal estate tax exemption amount of $5 million. For Minnesota, it's $1 million. And the concept of portability does not exist for Minnesota estate tax purposes. So yes, each individual married couple has $1 million exemption, but you would essentially have to split up your assets between a married couple in order to both benefit and receive your $1 million exemption. Another provision that we should discuss here is the 3-year look back. This has to do with deathbed gifts. These gifts are now pulled back into an estate of a decedent, and this would include any gifts that were made within a 3-year period. Another area where they made changes has to do with non-residents. While it's true if a non-resident owned property directly in Minnesota that it would be subject to Minnesota estate tax, if they put that property into a pass-through entity like an LLC or an S-corp, prior to the tax law change, that asset would not be subject to Minnesota estate tax. So if you took your family cabin and put it into an LLC, that would be one way to avoid Minnesota estate tax, but they changed that effective June 30th of this year. If you put that property into an LLC, the state will look through that entity as if you own the property directly, and it will be subject to Minnesota estate tax. It not only applies to real property, but also personal tangible property. So this is actually a fairly complex piece of law that they put in place. We're not exactly sure at this point how Minnesota Department of Revenue will interpret the rules and how they'll be applied. We're waiting for guidance from the Department of Revenue on that. Another item here is that we now have a gift tax. There are currently 2 states, Minnesota and Connecticut, that have a gift tax. Other states have had gift tax over the years, but have repealed them because they found that they were very costly to administer. We'll see if Minnesota continues that, but it's currently a 10% gift tax rate. The $1 million exemption that I previously discussed can also be applied for gifts. So if you gift, you can gift up to $1 million before you would have to pay the 10% tax. And that is in addition to the annual federal gifting amount that you're able to make of $14,000 per person. So you're still able to do that and not pay any Minnesota gift tax. The final area where we saw significant changes had to do with sales tax. We saw that more and more services are now subject to sales tax. There were two controversial items that were put into law sort of at the last minute that are subject to tax now or will be in the near future here. One of them has to do with farm equipment repairs, and the other one is the warehouse and storage tax. Both of these provisions are very unpopular with lawmakers, and we suspect that these may be repealed. We're not exactly certain, but we're hopeful that that'll happen here in the next couple of months. Well, that concludes my presentation. I'll now turn it over to Greg Krauser.